Are we live?
You're live, guys. Look alive.
This guy.
That's definitely not 60. I don't care what anybody says.
What's up, everybody? It is Thursday. Almost missed our show time, the show start. Got close that time.
We made it.
We did. Thursday, 4:15, we got in.
We did.
Had a little music playing for you again. I don't think anyone guessed yesterday what it was.
No.
Yeah, that's all right. What are you going to do? We ended up today. It's another clue for you, another green day.
It was a green day, right?
Hey-o.
Hello.
Yes. Steve, what do we got? We got new mics.
Mine's on the.
For those of you who cannot hear Steve, his mic is sitting on the chair. So we'll get that bad boy set up
There
right
you
away.
go.
Thank
There
you,
he goes.
Amazon.
That's it.
Yes, thank you, Amazon.
That's right.
So we're here today. The angel of death has passed over our bullpen.
That's good. Good stuff.
Yes, yes.
Yep.
Didn't stop here. We had a little lamb's blood on the. You don't get that, do you?
Oh, I do get it. I'm not quite sure if that's going to be appropriate or not, but hey, it's what it is.
It's a good Passover. The angel of death passed over us.
I don't know what people's beliefs are. Unbelievable. All right, so anyways, it's Thursday, 4:15, and we're talking about what? Dividends and stock prices, and what do you got?
Unless you're a lamb, you're not offended by that joke, okay?
Oh, man.
Yeah, so we're talking about when is a stock too cheap, and when is
How
a
can a stock be
dividend
too cheap?
Just stay tuned, you'll find out.
All right.
And when is a dividend too high?
Ooh.
Yeah, what do we got in the Wall Street Journal today?
All right, so we're using a different computer here, so let's see if I can find this bad boy.
All right.
Looks like the Dow Jones closed up 285.
What happened to 700 and 800 and all that?
I don't know.
Good old days.
Yeah, what are you going to do?
Yeah.
So a little over 1% up on that. S&P was up 39, almost 1.5%. NASDAQ was up 62. Ooh, 62 on that.
Yeah.
All right, so on the computer here, my friend.
She doesn't have a touch screen, just so you know.
I know.
I'm always touching her.
I just doing the same thing. It was killing me.
It doesn't work.
I know. So Steve's going to be talking to you for a second as I find where I can access some of the other additional information.
Take your time. We're in no rush.
I'm trying to find you live. You look pretty good, actually. I'm trying to
looking
find you
all right?
on my phone.
All right.
Yes.
Videos.
I got pop-ups on this computer. This show's a mess right now. Oh, my God. All right, so we get the 10-year. Here we
Yes,
go.
10 years.
0.729. That's good stuff.
Yes. Waiting for 1%.
Waiting for 1%. Gold. All you gold fans out there closed up 48 to 1732.
Mm-hmm.
Good stuff.
Yeah. So, wow. That's actually, it was just a few weeks ago. I think it was around the 14, 15 neighborhood. So it seems to be creeping up. Or
Creeping
maybe
up?
it was more than 2 or 3 weeks ago, and I'm just not paying attention.
The days are starting to blend together.
They are, aren't they?
Yeah, yeah.
We're going a little stir crazy like everybody else.
I think most people probably are, yeah.
But I hear it's working. Going stir crazy is actually saving some lives, and I hear that some of the numbers are looking a little bit better. But we're all concerned that everybody's going to run out there a little prematurely, saying, "Hey, everything is great. Less people are dying, so it's time to run out and play, soccer or something like that." And so
That's a concern.
Yeah, so
It is.
so, yeah, yeah. But today's topic,
Today's topic.
yeah.
Stock price too low, dividend too high.
Yeah. This is actually a tough concept for me to be able to really put across to some people. When I'll get a call from someone, they'll say XYZ is trading at $10 a share and it used to be 80, so it must be a bargain.
Right.
But they're using that 80 mark like if that's really what it was worth, right?
It's true. Yeah, I can see that.
Yeah, and that's really not the case. Sometimes a stock goes from 80 to 10 because it belongs there.
Dude, sometimes it goes from 10 to 0.
In fact, I remember years ago when I studied for my license, they said that the risk is always that a stock can go to 0.
Buddy, I had it go to 0.
Was that one of you? Was that you?
Yeah, I had one with a 0. I was playing with some penny stocks. I'm like, hey, it's a penny stock. Might as well throw some money in this bad whamma jamma.
Uh-huh.
And lo and behold, the company went bankrupt.
Here's where we insert the disclaimers.
Yes. What do we got?
we don't sell penny stocks. To our
No. This is
clients.
long before. This was like I was like barely out of being a teenager, for crying out loud.
Uh-huh.
Yeah,
Okay.
yeah.
I gotcha. All right. So, you know, the first thing is, you know, how many shares are out there? When we try to value a company, and we say, okay, it's gone from 80 to 10 and so forth. How big is the company really? You know, how many shares are out there? Because when you price a company, you hear terms like earnings per share or price to earnings ratio is based, again, on a share. So we have to determine how many shares are really out there. And, you know, if it's a company that has like just a ton of shares that are out there, you know, that's going to factor differently. So, I mean, if you have a company that only has 10 shares issued, right, and it's $80 a share, that $80 just bought you, you know, 1/10 of the company.
Right.
But if there's like a bazillion shares out there, you know, so the share price in itself doesn't mean a darn thing unless we have something to compare it to. Comparing it to earnings per share, comparing it to the price and so forth. So we'll talk a little bit about that. And then the second part of it is, you know, when is a yield too high? And you say, well, that's impossible.
I know. I would love to have,
Yeah.
you know, a nice juicy yield on everything.
Exactly. And you know, a yield can be too high. And there's a term in our industry called the accidental yield.
Ooh.
Accidental yield. And that's when a company, now, we quote yields, dividend yields, on a percentage basis, right?
Mm-hmm.
But companies don't really issue dividends on a percentage basis, do they?
They do not.
How do they usually issue them?
I'm going to say like from whatever kind of profits they have, well, assuming they're profitable, some probably borrow just to pay a dividend in some cases.
Right.
And then they'll just divvy that up amongst the shares that are outstanding, and determined, I guess, by the board of directors.
It is the board that votes that in, right? But do they vote it in when they pay it? Do they pay it on a per share basis or on a percentage basis?
No, on a per share basis.
They say check your
It's
mic.
it's a check my mics.
Yeah.
Are we not being heard properly?
Keep talking.
Oh,
I'll keep talking.
Yeah.
Okay.
All right.
So if the board declares a dividend based on, say, $1 per share
Okay.
or $5 per share and so forth, they're not calling it a dividend yield, a percentage. So if the stock is trading for $100 a share, let's just say that, and they decide as a board of directors that they're going to pay a dividend of $5. And let's say it's an annual dividend, right, of $5.
Right.
We quote it as a 5% dividend yield. When we go on, let's say, Yahoo Finance, and I'm going to pull that up for a second because I want to pull some just sample stocks of kind of what's going on today and talk about some individual stocks for a change.
Sure.
Without having no idea what I'm going to pull up on my screen. We'll just kind of wing it, right?
Crazy stuff.
It is crazy stuff.
Hang on a second. Are we all right? The mic's working or what?
I believe so. If you give me 1 second, I'll let you know what I hear from the desktop.
All right. Just gonna make sure our mics are working here, people. Oh, look at that.
Maybe a little bit low.
It's all right.
Can we just move the mics a little closer?
We could.
A little closer.
Sorry, guys.
I see Bill Hughes there. Hi, let's do taxes.
All right.
No, we'll always got taxes. I'm
So hopefully we don't get too much feedback bringing them up close, but
Yeah. Okay, how do I sound now? Testing 1, 2, 3. I sound
Find
okay?
sorry, people. A little technical difficulties, but we'll work through it.
It's Jay's fault.
Appreciate your patience. Try to step up the quality here.
Yeah. So Bill says let's do taxes.
good. Keep talking, guys.
And actually on Bill's Facebook, I'm seeing a lot about some of the government programs that are out there to assist people. So anybody who is not following Bill Hughes, Bill, I'm not really sure how someone finds you. Do they just do a search for Bill Hughes, or what would be the best way for some of our friends to find you on Facebook? You post some really good and helpful tips there on some of the government programs that are out there. And,
Cool.
and
Well,
some-
maybe you can type that in so it'll be on there for everyone to see.
yeah, that would be great.
Yeah.
yeah,
Get in there, Bill.
yeah. So,
All right,
so
so-
I mean, and we'll get back actually to the stock thing. But he said let's do taxes, and I'm like, okay, let's also do these these government programs that it is tied into your tax return and all that other stuff. And I was kind of trying to figure out one of them today, and it looks easier, but when you start diving into it, you could probably use a little bit of help. And maybe Bill's one of those guys out there that'll help you, right?
All right.
Okay, so getting back to that dividend, that fat, juicy dividend.
Yes,
So
yes.
let's say we have a company that is trading at $100. The board of directors says, let's pay a dividend of $5. And you and I, when we talk to a client, we say XYZ is paying a dividend of 5%.
Right, because $5 on 100 is 5%.
Exactly.
Yeah.
Okay. So what happens if some terribly bad news comes out about that XYZ company? And now it's not $100 a share anymore.
Yeah,
It's a $50 company.
right.
The board of directors, they don't feel that they need to change the dividend.
They're
you
still
know.
going to do 5 beans.
They're going to do 5 beans.
Right.
So, I mean, they didn't really think about it on a percentage basis. They
No.
look at the earnings per share that comes in. They look at what they can throw out to investors. Let them do the math and figure out what the percentage is.
Right.
Right.
And now your yield just went up to 10%.
10%. So
Right.
that's wonderful, right? Well, I just own it. I'm buying a stock that just got cut in half. Maybe I should ask myself, why on earth did that stock just get cut in half?
Yeah.
So that's kind of an accidental yield. You know,
All right.
when we say accidental yield, we're saying that, you know.
It's German. You're too soft.
I'm too soft. If I brought this mic any higher, it would be dinner.
I'm surprised
Thank
that
you,
his is.
Danielle. I appreciate your help.
Danielle, do you really need to listen to him? No, I mean, come on.
Yeah.
As long as Jason's being
As long as
Hey.
as long as you can hear Jason and see Jason.
It'll be all right.
Okay.
What's going on with your mic, man?
I don't know. This is Amazon's finest.
Can you hear me now?
I
Can you
think
hear-
it was just, I could hear you, so I think
Okay.
it was just a little bit low.
Could it possibly be Danielle?
It could be
I
Danielle.
don't know. I think she can hear me.
No, she can hear you. Okay.
Good thing we're not live.
Yeah, guess what? We are, right? All right. So, somebody throw a stock up there. I want to give an example.
Home Depot.
Home Depot. Okay. And if you guys
Procter Gamble.
and hey, Glenn, how are you? Glenn, we're talking
Glenn popped in?
we're talking about accidental yields, and a stock that gets cut from 100 to 50 is paying double the yield. So, we want to talk about how to really value a company. And I'm trying to touch Melissa's screen, and I'm reminded that
It's not a
I need
touchscreen.
an upgrade.
she doesn't have a touch screen. She needs to talk to her employer about getting better equipment around here, okay? So Jay wants me to look up Home Depot.
Let's do it, man.
Yeah, and I have it up on the screen now. And I also want to have some of our friends on Facebook to throw up some stocks that they want me to kind of put up there and talk about valuations. We're not making a recommendation that that anybody buy these particular stocks that we
Nah,
talk
but they
about.
can get a little bit inside your head to see some of the stuff you may take a look at.
Right. So when I look at Home Depot, it's trading at $200 per share. Okay. If this, let's see, it was, I'm assuming, a little higher at some point, like everything else. So it was 242. Went down to 200. That's a 20% drop.
Yep.
Okay. The yield went up in Home Depot. Now Home Depot is probably one of those companies that I think it's good to own the company. It's going to be around for a very long time. So it's not an example of something that's been cut in half.
Big fan of Home Depot.
Are you really?
Yeah.
I spent a lot of time there myself. Okay.
Yeah, it's like one of the only two stores I shop at, for crying out loud.
Right.
Yeah.
So when somebody says to me, I like Home Depot, what do you think about Home Depot? First thing I look at is how much money do they earn, right? Because if a company can't make money for itself, don't expect it to make money for you.
That's true. Now, do you just take a look at the earnings, or do you actually calculate it out? Because I know a lot of times they'll report on different things on like an earnings per share, or do you do the math and say, hey, what's the overall earnings for the company?
Well, I mean, I do some of that also, but if I could recommend an easy site, it's Yahoo Finance. You go to finance.yahoo.com. And we spend thousands of dollars on software and packages and all kinds of things to run our practice. And oddly enough, the website I go to most of all to get information is a free website. Now, over the years, they've upgraded certain parts of it to premium services and try to get you to buy into that premium package.
Yeah.
But they used to be all free. But
Well, because I remember years ago too, that and I think MSN Money, you could go back further and take a look at some of their historical things. I think Yahoo Finance only goes back 3 or 4 years, right?
No, actually, it goes back longer.
Get
And by the
outta
way,
here.
we got some excellent stocks to take a look at
Oh,
here.
sweet.
So, and you know, yeah, New York Community Bank and Apple will pull up. Okay, but now that I have Home Depot up, just as I look at it and I say, okay, it earns $10 per share. But that doesn't mean anything to me if I don't know how many shares, right? If they own 100 shares, they've only kind of earned $1,000, right?
That's true.
So it depends on how many shares. So without knowing how many shares, what they earn doesn't really mean anything. But it is the first thing I look at because I want to make sure the company is at least earning money.
All right.
And I want to make sure that if they're paying a dividend, that they're earning significantly more than their dividend. Because if their dividend is too high because the stock's gone down and their costs are going up and the company's going through problems, but they don't want to cut the dividend,
Yeah.
they may be doing that more for public relations and less for the health of the company. Sometimes you've got to cut the dividend for the health of the company.
Right.
So we want to look at the earnings per share. We want to look at how much of that's being spun off as a dividend, how much is being retained. Yeah.
And that's a good call because I think somewhat of the old school mentality may have been that, hey, you know, I want to invest in something that's spinning off and cutting me a nice check and that does have a good dividend. And then the companies at all costs would make sure that they upheld paying a dividend, even if they were borrowing money to pay it out.
Right, which is a huge mistake.
I would think so.
Yeah. So in the case of Home Depot, earning $10 a share, one of the things I look at is something called a PE ratio. I've mentioned it a couple of times.
Yeah.
Now, granted, the E part is going to be somewhat questionable going forward because of the virus.
Right.
But I'll pretend for a moment that we don't have a virus, right?
Sounds good.
So that price to earnings ratio is basically saying, hey, that $201 that you're spending, you know, for the company, how much are they earning per every dollar you spend, right?
Right.
So the price to earnings ratio is basically the cost of the stock as compared to the earnings. So that ratio, a lower number is a good number. If it's 10, that means you're paying $10 for every $1 that they earn, right?
Yep.
You're never going to be one for one, right? I
No.
mean, you know, the company's going to trade at a premium to earnings, and plus the earnings, that's not a net number anyway, right?
Right. I mean, and if you just put it in the context of terms of that you were out in the world just buying a company.
Right.
I mean, unless you were buying your neighbor's lawn mowing business,
Right.
you know, you're gonna the PE is gonna be a little bit higher. Like you
Right,
said.
and that's usually to sales, not earnings, right? Because sales is a much bigger number, right? So companies can trade at a certain amount times sales. But the price to earnings, which is the lower number, you know, sales after expenses and
Right.
so forth, right? A 15 to 16 number is a good average number for stocks. Some stocks, you know, typically trade lower, some are higher. So Home Depot right now is trading at a 19 PE. Now I'd say that's a little expensive, right? Because the S&P 500 typically trades at a 15, sometimes 17. So what this says is that you are spending 19, when you do the math of that $200, you are spending $19 per $1 that they earn.
Yeah.
So if you multiply that out, you'd get your earnings per share. So that PE number is a number that you want to see low, right? The dividend that they're paying here, they're paying a $6 dividend, but it translates to 3.12%. Now tomorrow that could be 3.5 or 2.9 because the dividend's still going to be $6.
Yeah. It's gonna be just based off the price.
That's right. But it's a healthy dividend for a company this size. It's not a ridiculous dividend. It's in the ballpark. Historically, the S&P 500 has spun off about a 2% dividend yield.
Is that right?
Yeah, that's kind of historically where it is because we expect total returns from stocks. We want to get a little bit of dividend yield and we want to get some appreciation on the share price. We want a combination of the two.
And where would you look for that? On the equity?
What do you mean?
Would you want to see that the overall equity is going up in the company as well?
Well, that's simply share price, right?
But on the balance sheet, if you were flipping through and taking a look at, you got your assets, your liabilities, and take a look at your equity, you are okay if that kind of remains consistent?
Yeah, well, I'm not going to do a show on GAAP accounting.
Oh, all right.
We can ask Bill Hughes.
No, I thought you were jumping in on this.
We can ask Bill Hughes to come in and do one on GAAP accounting. But I mean, GAAP accounting will just two people will tune in tomorrow. They'll both be CPAs.
All right.
Okay.
Hey, no problem.
But just from the novice standpoint, you do want to know what that price to earnings ratio is, and it should be a positive number. If the company is losing money, that's you put up like a Tesla or something like that that's just burning through a ton of money.
Yeah.
Make a great car, They have a genius in terms of the engineer and CEO and ex Twitter member, but the company is trading at ridiculous multiples. PE is what we call multiples, right? They're not earning any money. They have an NA under the PE, right? I like to stay away from those things. I like to make sure my company is earning money, right?
Okay.
So PE and this, it's a little pricey, but sometimes we'll pay a little bit more for a company if we think there'll be some growth at the end of the day. So what the street's telling us is that, well, Home Depot, even in this kind of depressed market, although we're up, we want to talk about the moose market for a minute, right?
The moose
market.
Yes, sir.
We are up off of the bottom.
Yes, quite a
bit.
Yes.
Yeah. But Home Depot is certainly one of those things where, people that are around the house, I don't know about you, but I just bought a new pool water heater, and I got all kinds of projects I'm doing
Buddy, I
around
was just
the house.
on there today. Yeah.
Yeah, so I'm happy to see that they're open, and they may actually be a beneficiary of some of this craziness once the chips are counted.
A lot of honeydew lists getting done.
Yeah. Tell us a little bit about what we call the moose market while I pull up New York Community Bank and Apple.
All right, so the moose market, this term was coined quite a while ago. I think it was at least maybe 23 hours ago we were talking about it.
Yes, we own it.
Yeah.
We have the. We have
now
the
trademarked.
We're
That's
trademarking
That's
it
right.
now.
So we discussed how we went into a bear market a few weeks back, right?
Right.
And Steve said, hey, if we ever went down around, like, let's say 45% off our highs,
Right.
so we're technically, we blew through into a bear market, and then we came up like 22.5%, right?
Right.
Then we're kind of at that point back into a bull market. So we're in a bear and a bull at the same time.
Yeah, I wonder how many times historically you can actually say that happened, because you have to fall more than 40% for that to happen, obviously, right?
It's
20
crazy.
and 20,
Right.
and then 20 back up, right?
Yeah.
So I would imagine 41%, and then on the way back up, somewhere in there, you're still in a bear market
And
a
tipped
bull
into a
market at the
Yeah.
same time.
Yeah.
That is nuts. And I didn't even think about that till we were talking about that. Well, like, are we in a bear market or a bull market?
Yeah.
Maybe some of our participants out there on Facebook could tell us, do they think it's a bull market or a bear market?
There you
right
go.
now?
There you go.
That's
That's why
good.
we're calling it a moose.
We're not sure.
Camel market?
We're not sure. It's a what market?
It's not a camel market?
A camel market. Yeah, well, you got the two bumps, right? One for the bull and one for the bear. Maybe so.
There you go.
Okay. So New York Community Bank. Glenn likes New York Community Bank. Okay. I think it's a fine bank. I'm a New Yorker, so a lot of New Yorkers actually know the bank because it is considered a regional bank. Regional banks are going to bank in a small part of the country as opposed to the large money center banks like Bank of America and so forth, right? You don't like Bank of
Well,
America.
I'm personally not a huge fan of it. Yeah.
Okay.
Yeah.
Not the stock, just the
No,
company
no, no,
itself.
exactly. Yeah, yeah, like the customer service side of things. Although I got to tell you, that can be a driving factor for people when they are investing in companies. If they had a personal experience that they like or didn't like about a
Right.
company, they may make a decision based off of that.
No doubt.
Not that this is a recommendation or any kind of kick in the teeth to any kind of bank, but
Bill Hughes was on the phone when you guys shouted out to him, so. Bill, that's
fun.
your cue. He said, what was my cue?
Oh boy, sorry we missed your call, Bill.
so we're talking
he
about
was
a.
on the phone
oh,
when you guys were calling out to him, so he didn't hear what you were saying about him coming in with talking about the taxes.
Oh,
yeah,
nice.
yeah,
And I
thanks.
see an old friend, Tony. Hey, Tony, how are you? Tony Muratori from all kinds of people from my old neighborhood are popping
well,
up.
there you go.
Yeah, so Glenn likes New York Community Bank Corp. Okay, so he brings that up as an example, and so let's put that to the test. Let's look at the earnings. Let's look at the price to earnings ratio. So there again, Yahoo Finance is where we go for these things.
Okay.
There's a lot of other sites, but they seem to be one of the cheapest and I think most powerful sites for the amount of money you spend, which is zero. The premium site may be even better than that, but I don't like spending more money unless I have to. So they have New York Community Bank as a $13 PE.
All right, so it's pretty close to what you were saying.
Right, and that's actually below the average, right? So in the case of New York Community Bank, we're paying $13 for every $1 that they've earned, as opposed to, say, Home Depot.
Which is paying 19.
Right.
Yeah.
Now, that shouldn't be an absolute, but that's a great place to start, right?
All right.
And we look at their dividend. Now, their dividend may be a little accidental. It's a 7% dividend yield here. So the company is only trading at $10.57 a share. So their dividend is 0.68. But when we multiply that out, that comes out to a 7% dividend yield, Now, are they an accidental dividend? I think partially,
All
right?
right.
Because knowing the company, their dividends have always been a little better than some of the bigger banks that are out there, and
Okay.
and they've always had the profits to kind of back that in my history with being in and out of the company. But this is a stock that okay. This is bear market rally.
a bear
Okay,
market rally.
okay. I'm gonna get. I like that. So New York Community Bank was as high as say $24, years and years ago, right? But if we look at recent year to date, have they gotten killed? Well, they went from 11 to looks like 8, and then back up to 10. But at the high of the market this year, they were in that $10-11 range, and now they're about 10, almost back up to that.
All right.
So I would say New York Community Bank at a 7% dividend yield, I wouldn't even call that an accidental dividend, because that's pretty much where they are. And you could look at the history of the dividends to see how long they've paid that. Have they had dividend cuts? And you could also do that on Yahoo Finance too. So when I look at earnings per share, make sure they do have earnings per share. When I look at that PE ratio to see if they're earning enough per that, and then when we look at the dividend, we look at the dollar amount. I mean, they're paying out 0.68. And here's something that Glenn may want to take a look at that to me is a little bit of a red flag.
All right. What do you got for us?
It says the earnings per share are 0.77. So the PE is good, but mind you, it's a $10 stock, not a $200 stock. That's why the ratios are so important, right? Because, you say, well, this is cheap because it's $10. Maybe, maybe not.
Yeah.
So the PE ratios are nicely where I like it. It's a good company with a history of paying dividends, but the dividends may be just a little high here. And here's why. If we look at the earnings per share, it's 77 cents. If we look at the dividend, not the yield, the hard dollar, 0.68. Okay?
Yeah.
They're
It's only
paying off.
9 cents less than.
That's not retaining a lot of earnings,
No.
right? So is it possible that the board of directors will meet and say, hey, guys, we're paying out an awful lot in terms of our earnings per share? My guess is they probably readjusted their earnings per share. A lot of companies have decided not to give guidance whatsoever.
Right. So I wonder if that is reflecting a true statement of where they're at.
Right, and that's why we almost have to, if we're doing this as an academic exercise to teach people how to really look to see if a company is cheap or not,
Yeah.
we almost have to make believe the virus doesn't exist for now, because, this is just the way the math is for now.
Right.
It may be
So
off.
it's just an academic conversation.
It is an academic conversation, right?
Because otherwise, also, you would, I would
Yeah.
guess, you wouldn't be comparing the numbers of a New York bank to
Right.
like a Home Depot.
Right.
I mean, because they're two totally different companies.
Right.
You know what I mean? Like if you're comparing Home Depot to Lowe's, maybe.
Yes.
And then you're getting the true,
Yes.
competitor.
Yes. Actually, that is an excellent point, right? Because when we're looking to see whether or not we want to own a particular company or a particular investment, there are two different schools of looking at it. One is bottoms up, and saying, well, I'm not going to look at what sector they're in, what their peer group. I'm not looking at any of that. I'm just looking at fundamentally what kind of company they are, right? I think there are some flaws to that, because there can be a big tailwind that's going on that's dragging just a particular sector. You can be a great company in a bad sector. So to your point, Home Depot being in the building supply sector and New York Community Bank being in a regional bank sector, you shouldn't be making that comparison, right? So if you're out there looking for investments, the top-down approach, I think, is a good way of looking at things. Going from, hey, how's the economy? Do I like the market here? I'm not making a market call, but is the market cheap? Is the market expensive? And then what parts of the market do I like? Do I like technology? Do I like banks? Do I like, retail and so forth? Then you can look at a Home Depot, or you can look at a New York Community Bank Corp, because you've already made up your mind that you think banks are a good place to be, and you're just trying to find what
Which
bank,
one,
right?
right?
And so then when you do that, you'll take 3 or 4 of the banks and you'll line them up side by side, and you look at the earnings per share, and you look at the PE ratio, and you can actually go on to Yahoo Finance and look year over year at the top line revenue. that tells a huge story right there. Because you'll see numbers that are staggering because it'll say in the thousands, so you add them up and it says, well, this company did 6.3 billion.
Right.
Well, then did they do 6.4 billion and 6.7 and 6.9, right? So we want to see top line growth almost always in every company in every sector. We do want to see top line growth, right? So if we see top line growth, we see good PEs, we've had a good experience with that particular product or company. They're paying a nice dividend yield. It may be something that you want to look into and have a conversation with your financial advisor. By the way, your financial advisor is not going to be or shouldn't be upset if you go over his head or her head, so to speak, and pick a couple of stocks. In fact, most financial advisors, if we're being honest with each other, get really good advice from our own clients. Every so often, one of our clients will give us an idea that they found completely on their own, and we say, wow, that's pretty good.
Yeah.
And then we call our other clients and offer it to them, and sometimes we're honest and say, hey, one of my clients gave me this idea, and sometimes we say, I came up with this all by myself,
Nah,
right?
get out of here.
But
No
in
one
those
says that.
yeah, but in those honest moments, we do. But I do want to make a point, Anthony or Tony. I see Anthony on Facebook. It's Tony. Tony. Why do they call Italians Tony? Do you know this? Melissa knows it.
I don't know.
I don't know this.
Melissa knows it. She's my daughter. She's heard the joke 1,000 times, right? Well, when they came over, they had tags on their toes that said "To New York," Tony. Anyway, so Tony Muratori, old friend of mine, says an answer to our question: is it a bear market or is it a bull market? He says this is a bear market rally.
There you go.
So, I mean, what do you think the difference, Tony, is between, say, a bull market and a bear market rally? I mean, if you had to guess, what do you think he means by that?
Well, because we technically tipped into bear market territory, and now we're rallying up.
Okay.
So, yeah.
Okay.
I mean, I'm with him. It sounds good.
It's a rally.
It is.
But I don't think it sounds as committed as a bull market. I think
It's not.
what Tony may be saying is we're rallying, but we're still in a bear market.
Correct.
So, in other words, don't believe that this is going to continue to go.
Right.
And I hope Tony's still around. He can weigh in on that. But, does Tony mean that we're moving up, but he doesn't think we're ready to get back to where we were before, that we may pause and pull back a little bit? So when I hear bear market rally, that tells me that we're rallying, but we're still in a bear market. And so we're not done experiencing pain.
Right, and we talked about a week or two ago about like possibility of retesting some of those lows that we saw. So maybe that's where his head is at as well.
We're getting further and further from that.
We
because
are.
I think we're at 23% off of the lows.
We really are, yeah.
It's hard. I mean, if we went back down 23%, especially if it happened in 16 trading sessions like
There
it
would
did
have to be some
before.
crazy news that would drive that down, I would guess.
It would. So at Apple, another Glenn. We have two Glens that tune in with us. Glenn wanted us to look at Apple. I'm not surprised that Glenn wanted us to look at Apple.
Hey, Glenn.
I told a story about hate email the other day. I'm not going to go into it again, but
People love their Apple.
people love their Apple computer. So we look at an Apple computer, PE ratio of $21 or 21. So it means we're paying $21 for every $1 that they earn.
So Anthony says, I believe there will be an opportunity to buy lower from here. Clarifying rally.
There you go.
Okay. So and Tony, I don't disagree with that. In fact, Tony and I worked together back in the days when we saw tech companies flying all over the place, and I think that this behavior here that we're seeing, this 23%, it is a little quick and almost a little irrational for me. I think a lot of people saw those numbers. I was getting calls from people that I didn't expect to get calls from saying, let's buy more of this and more of that. And I had mentioned that some of the other shows,
Right.
And in fact, the phone would ring, and when the market's down 35%, most of us go under the desk and we start looking at the gum under our desk and so forth because we don't want to pick up our phone, right? But I always pick up the phone and I see the caller ID and I'm like, oh boy, I think this person is going to tell me to cash in everything, and she's scared to death because she's 80 years old. She's a little old woman, and oh my God, right? And if she was a little old woman, I wouldn't have put too much of her money in stocks anyway. And I'm exaggerating the point, but I would pick up the phone, and it was one of my clients saying, "Hey, what should we be buying here?" You know, and when a broker or an advisor has that experience with a couple of clients, it's safe to assume that advisors all over the country are having similar conversations. So,
Right.
so I think I saw a lot of people saying, "Wow, this is a bargain. This is a bargain." But I think that is kind of short-lived. I happen to agree with Tony that we may test that again. I don't know if we're going to test the whole 23% going down.
Probably not.
But I think,
Hopefully not.
yeah. But I think, I mean, we're in a recession because we think we're in a recession. But think about it: we haven't even seen the prints yet. Prints, in other words, the GDP quarterly numbers. They're not out yet. We think we're in a bear market, I'm sorry, a recession. It feels like it. Another 6 million jobs went away this week. Yeah, it certainly feels like it. But we haven't had that confirmation yet. And we're already bouncing back, right? We're already saying, well, we hit the bottom. We're getting ready to go back up. And we don't even know if it's a recession yet. We don't know what the scope of this really is. So I have to say that I'm with Tony on this one. I think that there'll be opportunities. Again, I try not to make market calls, at least not on air. But I think there'll be some opportunities to buy. So,
Well, speaking of opportunities, let's get back to Apple and see what we got going on. You were saying where we were at on the PE?
okay. So Apple has a PE of 21,
All right.
right? Now,
I got to tell you, I would have figured Apple would have been a lot higher.
and you know, you're right to think that, because we look at an average PE, but there are 11 sectors, as we know, in the S&P 500. And some of those are utilities. The utilities are not going to have
Explosive growth.
They're not, right? So, you know, PE also has something called a PEG ratio, which we're not going to get into in great detail, but the PEG ratio is not just the PE, but the PE growth, right? What that basically means is we'll pay a slightly higher PE. We'll pay up for that because we think tomorrow their earnings are going to be so much greater, right? Well, that's hard to imagine that in a Con Edison or a FPL or, one of the Pennsylvania power companies and so forth. Because they're utilities, they move slow, they pay their dividends and so forth. And if you looked at the top line, it's, 500 million, 501 million, and that kind of stuff. You look at Apple, it's like 3 billion, 8 billion, and that kind of stuff.
Right.
150 billion. And it just staggers the mind, I've said it before, they have more cash than most third world nations.
Pretty crazy stuff.
It is crazy stuff. So, yeah, you'll pay up a little bit more for that. So you're right to think, Apple, in your mind, probably was a little higher. And by that matrix, their PE of 21 may not be that far out of line. In fact, there's a company, Qualcomm. I'm wondering if Qualcomm is still around, but Qualcomm was one of CERTA. Glenn, I don't know if there's a stock symbol for CERTA, if we can check that, okay? There was a company called Qualcomm. I think they're still around in shape.
Pretty sure they
form.
are.
Yeah, right? But Qualcomm was a high flyer, right? And, I came into this business from another business where I had to look at certified financial statements on a regular basis. So first thing I would look at is balance sheets, and there's a tech boom going on. And people, what is this balance sheet stuff that you're talking about? They're looking at charts and, moving averages and all that stuff. And I'm like, well, how much money did they make? What is their PE? And I looked at Qualcomm, and they were trading at like a 600 multiple. And
Just ridiculous.
it was nuts. But people didn't care about that. We had an analyst by the name of Henry Blodgett, and he was working for Merrill Lynch at the time. And he was their tech analyst. And I still see him pop up every once in a while. I throw something at my TV. Because I remember in the late 90s, him coming out and saying, oh, PEs don't matter anymore. Earnings doesn't matter anymore, right? And we said, that's ridiculous. Earnings always matter, okay? So of course, he was wrong. And ultimately, earnings did matter. And I had a client that made a lot of money on Qualcomm, but when I saw the valuations, I said, listen, I think you should sell. It didn't go down right away, but eventually it did. But I called my client back and I said to him, I'm sorry if I told you to sell this because it appears to keep going up, but I think I had good reasons for telling you to sell it, right? My client says to me, Steve, if you asked me the best way to get to Europe, I would tell you to take a plane. I says, okay, where's this going, right? He says, well, if you took a plane and it went down over the Atlantic, I still gave you good advice. It just didn't work out very good. And I thought that was very gracious from a client to come up with that, right? But that is true. Sometimes we give advice that's prudent, and then the market has its own idea on what to do. And with earnings, it's pretty much like that too. Sometimes you'll see earnings that are completely out of whack, and the stock may keep going and keep going and keep going. But one of those two things are going to change at some point. Either their earnings are going to pick up and triple because they really came up with something, or the stock price is going to come back down. But you cannot keep a 600 PE forever.
So is that the hope with a company like Tesla, that people are investing in that because they hope that something is going to come out of this dude's head that is going to just rock the world?
I have no idea what's in the mind of somebody who invests in a company that loses $700 billion a year.
All right, fair enough.
For the life of me, I cannot understand that, okay? Sealy, TPX. I'm touching Melissa's screen again, okay? I'm just going to have to buy her a different computer just so that I don't embarrass myself by reaching out and touching the screen, okay? I'm wondering why Glenn likes Sealy. Is it that people are going to be spending a lot more time at home and laying in bed?
He's actually funny because that's what I thought.
Right.
But it's an inside joke going to the mattresses.
For money? For cash?
I'm thinking either underneath the mattress
Okay.
or people are on top of those mattresses. Either way, I think
Oh.
it's funny.
So if the show was not a rated G show, there could be something else gleaned from that comment. I see. Okay. Nice. All right, Glenn. But actually, you know what? Serta, it is interesting because people are spending a lot more time at home. And we talk about the obvious plays, right? Well, the obvious play is Netflix, is Disney Plus, all these subscriptions that we're just laying there watching TV all day,
So you
right?
think you're laying there and saying, hey, my bed's not that comfortable?
At some point, either you're going to realize that your bed's not comfortable, or you're going to make it uncomfortable from laying in that stupid thing for so many hours, right?
So what are their numbers saying?
So let's see what they say, okay? Look at this, a PE of 13, right?
I actually bought a mattress last week.
You did. Okay.
So I'm just saying.
Thank you, tax return.
Thank you, tax return.
Okay. So PE of 13. Very low PE. I like it. If it was a tech company, I wouldn't like it, right? So for a tech company, 13, something's wrong there. We almost want to pay up a little bit more for a tech company because we want to pay for growth, right? But a Sealy is not going to be a tech mover, right? So I thought that they had financial issues once upon a time.
Glenn says, cash is king, stuff the mattress. We love you, Glenn.
I like it. Okay.
Now, Scott McAllister has a good question. He said, since we will likely have a small but measurable inflation due to the stimulus, do you think it's time to buy into hedges like gold and real estate?
Yeah, yes and yes, but a qualified yes. Scott, give me 1 second. I'll get to that. So on the Sealy thing, they're earning $3.42 a share, and they're not giving any dividends. And again, I thought they went through some restructuring. I'm not sure. I'd have to double check that, right? But just looking at it briefly, very low PE, paying a nice dividend of $3.42 a share, and they're not spinning off a dividend.
No, okay, but now does it matter? I mean, I know part of the conversation here today is about dividends.
Right.
But whether a company is or isn't, that's not like a deciding factor, or is it for you?
No, in fact, Apple went many years without paying a dividend. So, in fact, one of our clients we got accidentally because we were doing a tax work and we saw this big dividend from Apple coming in, and we had no idea she had Apple stock, and she forgot all about it. And it was like $2.5 million worth of Apple stock. So if they're not Don't ask me how you can forget about $2.5 million. Another conversation.
All right. If you're looking at any company and they're not paying a dividend, would you look somewhere else to see what they are doing with some of the retained earnings they have?
Absolutely. So if they have a restructuring issue, again, I think that there was some issues with the mattress companies going back. I'd have to look. It's not important enough to do the research on that right now. It's more important to answer your question as to whether or not you should look to see if they're doing something else with the money. And yes, so they may have gone through some restructuring. They may have a lot of debt. Or, in the case of some tech companies, they may have CapEx expenditure, research and development, biotech companies, that where they're spending a ton of money and you get a better return on your assets by them reinvesting that dividend. Say, no, thank you very much. Keep your dividend.
Right. Because we like what you're doing, and you keep coming out with a new product, the next greatest thing, or whatever the case may be.
Right. And what you're doing with the money is a hell of a lot better than the maybe 3 or 4% dividend that you're giving me, right? So, yeah, good point. There are times where you're going to look at that dividend, and you'll look at it favorably. So then that's when you start to dive a little deeper into kind of the activity of the company, right?
Right. And again, today you're just kind of touching a few little things that you take a look at, but there's a lot more involved than just, hey, PE is this or that, and I'm going to buy a stock just based off that. Yeah,
and I'm glad we're talking about some individual stocks. And I want to keep this thing going because, not today necessarily, but I mean in future
general.
shows. Right?
Sure.
I want to keep this going because I think it is a good conversation to have as long as we're not making recommendations. As I said before, that's a full contact sport in my opinion.
Right.
You should do that one-on-one with your advisor, and if you don't have one, give us a call. Right?
Well, that's why I'm kind of shocked at where you're headed now with real estate and gold, because...
Yeah, I want to answer Scott's question on that. So it's been long thought that gold is a hedge. So I'm saying yes and yes, but yes, maybe not for the reasons that Scott's bringing up, right? So for many years, people have said to me, buy gold, it's a hedge against inflation. Buy gold, it's a hedge against inflation. And that's a conversation that goes back to the pre-Nixon days where, gold was $35 an ounce and that was pegged to our dollar, right? And in 1971, I think it is, we came off that gold standard. So gold itself hasn't kept up with its own inflation, right? So you go to the height of gold, which is, I don't know, was it $2,400-$2,500 an ounce in 1980 or 81, and then it hit that again 20-something years later. But it hit it with cheaper dollars. It didn't even keep up with its own inflation.
Good point.
So we're trained to think that gold is a hedge against inflation, but when you test the data, it's a true non-correlated asset class, which means it's not a hedge and it's not a hedge, right? So I think everyone should have a portion of their money in precious metals. Gold could be one of them, okay? Or a mutual fund that has many precious metals. But if you like gold, you can buy GLD, which is the exchange traded fund that tracks gold, right? It is a good thing to have. And yes, I think we're having inflation, or we'll have inflation with borrowing all of this money. There's no way that we're not going to have it at some point, right?
We talked about that on a previous show.
Yeah, but so I like his idea of thinking we need to look at inflation as a potential headwind down the line. I like his idea of actually owning gold. I just may not agree with putting those two ideas together, okay? So I'm not sure that was a good answer to that, okay?
I don't know. I thought real estate was mixed in that question somewhere as well.
It may have been. I didn't see it, okay? Okay. I think real estate is an excellent place to go, okay?
Do you think it's time to buy into hedges like gold and real estate?
Yes. So I am hedged for inflation in some areas. Again, I can't give the recommendation here. For those who are interested, give me a call. I'll have a conversation with you offline. But there are exchange-traded funds that are out there that will actually track yield, not bond prices. So if you find yourself an exchange-traded fund that essentially shorts the price of bonds, it means it'll go up when yields go up. So your inflation hedge, in a case where we have inflation, yields go up. So a hedge against that is to get something that makes money very specifically when interest rates go up. And they exist, and I can talk to you about it. You can do some research on your own for exchange-traded funds that track yields. That is the purest hedge that you're going to find out there.
There you have it.
Yes. And gold is a safe haven in dangerous times. Glenn, you're right, and it's perceived to be that way. I'm not really sure, and there are a lot of things that work, and I don't know why they work. I don't know why taking a quote from Warren Buffett that says, who've never invested in gold, by the way. He's got $120 billion in cash on the sidelines. Maybe he should consider it, right?
But because gold doesn't produce anything.
It doesn't.
It's not a business. It just sits there.
Yeah, and from a Warren Buffett standpoint, where he doesn't buy markets, he buys companies. He wants to know what you're making, what you're spending, what you're paying in dividends and so forth. Gold does none of that, and he's been on record saying, "I just can't invest in something that sits in the ground, doesn't earn any money." Right.
Right.
So to Glenn's point, though, that it's perceived as a safe haven, whether or not it is a safe haven or not, I can argue that it's not, but still, in times where people are fearful, more times than not, they will run to gold, which drives the price of gold up.
You think that'll always be the case, though? Because we saw we didn't quite see that negative correlation this time around.
Maybe there's not enough fear, and that's to Tony Miraturi's point that this is a bear market rally and that we may go back down, right? So if we were really scared to death, you would have probably seen gold go up. And we may not be scared enough. We may see what's going on with the virus and all this other stuff and say, hey, we got this, we got this. I got to be honest with you, I feel like, yay, we got this, we got this. I don't feel scared enough.
No, but we don't know the true full effect and ramification of what's going to take place when all this is now done.
We don't.
And we're going to see different companies that are going to exist and survive through it, some that aren't going to. Earnings are going to be slashed in different places. So we speculate and think that different things are going to happen.
Right.
But really, if we fast forward a year from now, we don't know. We don't know where we're going to be.
Right, we don't know. But I don't think that we're afraid enough right now. In 2008, and then going into 2009, I saw Bear Stearns go under. Then they got bailed out by J.P. Morgan and the New York Fed. I saw Washington Mutual. I saw A.G. Edwards, just a list of them. And then Lehman Brothers, boom, goes out, right? AIG almost goes out. I was working for UBS at the time, one of the largest Swiss banks in the world. And I'd come in every day, read the paper, and see what bank went out of business. I was scared to death. We were getting money into the Swiss bank side of the firm because people didn't even trust banks anymore. I had one client call me up and says, and they just increased FDIC from 100 to 250. This particular client was scared of banks. And I said, client, just spread it out so you have no more than $250 because it's covered by FDIC. I don't even trust FDIC. I'm taking the money and I'm putting it in my safe. And I said, Mr. Client, do you realize the same entity that is guaranteeing FDIC is also guaranteeing the money that you want to put in the safe?
Right.
The money is backed by the full faith and credit of the U.S. government. FDIC is backed by the full faith and credit of the United States government. You realize it's the same guarantor. And he stopped and he says, you're right. Let me do $250 per bank, okay? But that type of fearful thing where you do things that are really stupid, right? To Glenn's point, that's the type of fear we need to see to drive gold prices really up, because that's where gold is perceived as being a safety point. And there's no reality behind that.
Right.
But it's perception, and I don't think that we've felt that yet. And I say that kind of, I wish that we did feel it and we can send it behind us, because I don't like the idea of thinking that we didn't feel it yet and we may feel it and the other shoe's going to drop, or, the bully's going to meet me in the schoolyard and take my school lunch. And so that's never happened, by the way. And I wasn't the bully either. But you know my point. Just waiting for something to happen is scary. And so I don't think that we've gotten to that gold being a great place to be. I like it. I own it. It's actually in the portfolios that I manage here at the branch as a portfolio manager.
Right, but you don't have a huge percentage, though.
I don't, and I'm not at the point where I'm saying just drop everything and go to gold. Okay,
Right. And I don't think you ever would.
I wouldn't.
Right.
But it's when the investment public tries to do that, and maybe in some cases do it. It's when we see the celebrities. In 2008, it was Glenn Beck out there on television saying, this is where you got to put all your money. This is where you got to put all your money. Forget about the government. They're terrible. This piece of rock that sits in the ground and doesn't do anything is where you want to put your money. Forget about the government, right?
Right.
We're not there yet this time. And I part of me hopes we're not going to be there.
And we might not.
And we may not. You don't always have to be there. but that's what would cause gold to go up. You know.
All right.
Yeah. So
Well,
I
where
see
we at?
Lenny, I see Sam. They kind of joined us a little late. We're getting ready to get out of here, but hopefully they can catch us on the replay.
We've been on the air
I
for
think
7
we're in touch
hours.
with everybody.
Yes,
If anybody
yes.
else has questions, of course, they know they can comment or message us personally afterwards. We
Yes.
always welcome that.
Now, question. Tomorrow, are we?
I'm on the fence about tomorrow.
All right. So we may not be because it's Good Friday. It's
Yeah, it's Good Friday. You're talking about a
market
guy
closed.
who celebrated Passover with his wife yesterday,
Yeah.
and is getting ready to celebrate Easter because I was raised Catholic.
Okay.
My kids are in therapy.
Because the Christmas tree almost got burned down by the menorah.
Exactly. We learned not to have the menorah too close to the Christmas tree, so I'm not really sure whether I'm even observing this weekend or not. I'm waiting for my wife to tell me. So, you know, I mean,
So we may have a show tomorrow.
we may or we may not. Let's put it this way: I may work from the house tomorrow, and if I do, and you're not doing anything, you want to swing by my house with an iPad. Maybe we'll get weird. Maybe we'll take the day off. I don't know.
All right. So we'll play that one by ear.
We'll play it by ear.
Either way, thank you for joining us today.
Yes, thank you.
Yeah.
Thank you very much.
All right.
And you have a happy Easter.
We
If
good,
you-
Melissa?
If you if you celebrated Passover, I hope you had a good Seder yesterday.
There you go.
And above all, stay safe. And thanks again for joining us today.
Absolutely. So I'm gonna have to walk behind that bad boy and shut it off.
Go ahead. Do I put the music back on? A little bit of Green Day?
All right, you can do a little exit music maybe.
A little exit music.
All right.
Yeah.
Just say bye, guys. Let everybody go.
Later.
Happy Fridays.
Happy Friday, guys.